Tom Lee went on CNBC today and had this to say about markets. He says that the market is still in buy the dip mode. Well, in fact, ladies and gentlemen, I am here to give you bad news. The bad news is the bond market is breaking. We actually had bad economic data today, and bond yields skyrocketed. 10-year Treasury yields at the time of recording this video are up 10 basis points today, up to 4.17%. If you're actually rounding here, you'd round up to 4.18%. This is getting to a critical level that is starting to impact markets, and it may get worse from here. Now, I wouldn't say I shrugged off the bond move that we have seen since September 18th, where bond yields bottomed around 3.62% and have since started to move higher. But I also wasn't in the camp that this had to be some disaster for equities. But it does get to a certain point where it starts to dramatically impact markets. Now, the main theme that's going on right now that is affecting bond yields is the Trump trade. Investors think that Trump is going to win the White House, and maybe there's a red sweep or maybe a blue sweep, who knows. But the expectation is that there would be more inflation. The Fed would not be able to cut rates nearly as much as they are currently forecasting. But ever since September 18th, the data that we have gotten has shown the economy is doing okay. The thing that I have really been waiting for is bad economic data to see the relationship between bond yields and that bad data. And that happened today. And that's why today is so concerning. Today, the September Conference Board leading economic index came in at negative 0.5% month over month versus negative 0.3% as was the estimate, and negative 0.3% for last month. But this was revised down from negative 0.2%. So in fact, this is the second worst LEI reading that we have gotten since the start of 2024. And if you look at this on a cumulative basis, you are starting to get down to very low levels. The US leading index falling to negative 0.5% below forecast points to increasing economic headwinds. This suggests lower economic growth ahead, with potential weaknesses in key sectors like manufacturing and consumer spending. It's a signal that the economy may face mounting pressure going into the next quarter, warranting cautious outlooks from investors and policymakers. So you would have expected this economic data would have an impact in bringing down 10-year Treasury yields. Maybe not a whole lot, but at least a little bit. But again, that did not happen, and 10-year Treasury yields are coming unhinged. Fed Logan today said, "I expect gradual rate cuts if the economy meets forecasts." And she also says, "I see downside risks to the job market and ongoing risks to the inflation goal." So none of your Fed commentary today suggests that bond yields should be doing what they are doing. But it's not just American bond yields, it's global bond yields. As the great Martis on X says, the bond erosion is accelerating. This is not good. This, very bad. You can see Australian yields, Spain yields, Germany, France, they're all up anywhere from 1.5% to 3% today. And it's not like any of these countries are particularly doing good. Oh, did I mention that silver is skyrocketing, hitting $33 an ounce for the first time in 12 years? I think gold is even more impressive. Gold is hitting a new 52-week high today to $2,736.80 per ounce, up 0.25%. And silver is up 2.26% today, up 75 cents per ounce, almost to $34 per ounce. As Heisenberg writes on X, gold is literally telling us something. Look at their chart. Look at it in bold letters. And he's referencing other periods in time when gold has rallied like this. You tend to go through an economic catastrophe, to put it lightly, following that. T. Rowe Price is warning that 10-year Treasury yields could soar to 5% within the next 6 months. And it does seem like today Treasury yields coming unhinged, close to that 4.2% level, is finally starting to impact markets. The S&P is trading lower by 0.41%, whereas the RSP, the equal weight S&P, is down 0.85%. But let's give credit to where credit is due. Nvidia is up 2.26% today, and Apple is up 0.54%. If Nvidia and Apple were red today, this would be a much worse market. Michael J. Kramer on X writes, the market has only been open for an hour, and already Nvidia has traded 1/3 of the average call volume, and while actual volume is flat, meanwhile, the stock accounts for all the up price action in the Bloomberg 500. So the market is now dictated by one company's options. But again, for a moment, back to the imploding bond prices and upwards pressure on 10-year treasury yields that we are seeing. This phenomena is really because of the election more than anything else. At least from what we can see right now. There could be unforeseen things that are affecting this, like, I guess not unforeseen, but government spending, deficit spending. The world is kind of starting to revolt against the US debt. But I do think a lot of this has to do with the Trump trade being priced into markets. Ultimately, I believe this is the wrong trade. I believe the bond market is wrong on this. I do not think there will be elevated inflation under a Trump presidency. In fact, I think we could actually be struggling with deflation under a potential Trump presidency. Thus, I do think this is a short-term phenomena in nature. I do believe after the election, bond yields will fall and markets will come to reality. But the actual reason, or the functionality, I should say, of why bond yields are rising is investors are selling and or shorting the actual bonds. So prices fall, bond yields rise. This is like a self-fulfilling trade. So when I say bond yields are becoming unhinged, what I'm really referencing is investors are just shorting a shit ton of bonds. So everyone's starting to pile into this trade. Short bonds, short bonds, short bonds. At a certain extent, the bond market can get derailed from actual reality. And I think that is happening right now. As kind of like a meme stock will just rally for no reason, hedge funds, institutions, and algorithms are just shorting bonds because that's what's working. That's what everyone else is doing. And that can become a pretty scary dynamic once you start to hit these thresholds when it starts to impact equities. And I think you're clearly seeing that today. Just look at the yields on the 10-year treasury. Like, they are consistently climbing today for no reason. In fact, yields should be falling based on the Fed commentary we got today and the economic data that we got today. But it does appear as if you're starting to hit one of those critical inflection moments where bond yields are now impacting the markets. And unfortunately, when 10-year treasury yields rise like this, seemingly defying expectations, the rallies in yields tend to last a while. It tends to last until something changes. And given you're seeing an over 10 basis point rally in the 10-year treasury today, and equities are being dramatically affected by this, if this continues over the next couple of days, this week could turn out to be a not so pretty week for stocks. You can already see today the percent of stocks trading above their 50-day moving average is falling 7%. So 7% of all stocks today are falling below their 50-day moving average. That is a bad number. You can see we actually rose pretty consistently from the start of October until today in the amount of stocks trading above their 50-day moving average, going from about 53% up to 73%. And in just one day, we're now down to 61%, 61.57%. Still a pretty healthy number, but if you do continue to see bond yields become dehinged from reality, let's call it that, you will see more pressure on equities. I think the question is then, how does that impact Nvidia? How does that impact Apple and the rest of big tech? Because again, let's face it, this is Nvidia's market, and whatever Nvidia does, the markets will follow. Now, take a listen to this clip from Tom Lee, posted to CNBC this morning.
Where this rally goes from here this morning with Fundstrat Global Advisors Head of Research and CNBC contributor Tom Lee, who recently raised his target to S&P 6K. Tom, good to have you. I loved your note the other day looking at what S&P revenue has done in the face of declining inflation. And your general point is that real revenue has accelerated, and that kind of explains why equities have been so resilient.
That's right, Carl. As you know, many investors and pundits thought as inflation fell, and it's been cut in half in the last 2 years, that would cause revenue growth not only to hit a wall, but that earnings would stall. But instead, S&P revenue growth is going to be over 5% this quarter. And on a real basis, that's over plus 2%. And that's the strongest. It's really one of the strongest numbers in more than 2 years. And so it is a really high quality earnings season so far. And, close to 80%, or actually more than 80% are beating earnings so far. So it's a good beat season, but it's early.
Right. And how much of it is due to financials? Is any kind of tailwind, although we heard various comments about this, if a Fed tailwind does exist, is it likely to affect other areas of the economy as much as the banks?
Well, in your opening comments, you talked about industrials, and that's something to watch because last week financials reported, and it was, pretty much universally better than expected, and financials are doing really well year to date. But the other group that's very sensitive to the Fed cutting would be industrials, and there's a lot of industrial reports this week. It's about a quarter of the S&P, but I'd say it's so far so good. And again, industrials are doing well in the face of an ISM that's kind of been at rock bottom for 2 years now.
Tom, how much would you ascribe the recent momentum to aspects of the election as that draws near, just over 2 weeks away?
I think that's been a dynamic. I mean, I've been fooled by seasonality because I figured from September to Election Day, markets would be very tentative because this is an extremely close race. I mean, this is a coin toss, according to Nate Silver. But something that Stan Druckenmiller said last week might explain a lot, that markets are betting that Republicans could take the Senate, and that actually could ignite animal spirits. So there may be underlying momentum that the Republicans take parts of Congress, and that's why markets are bullish.
Are you at all worried? There were some comments out of German PPI was down 1.4 year on year, Tom, but there was some ancillary commentary about worries about a reflationary period, largely due to geopolitical events. We mentioned oil coming back a bit today. How worried are you about that?
Well, I think that headline CPI could definitely get affected because oil moves dynamically, and it has an almost immediate effect on headline CPI. And we know transport costs have also spiked recently. Part of it's seasonal, but that affects headline. I think the market's going to be somewhat skeptical that could trigger a sustained reigniting of inflation, but I think the economic data is going to be a little confusing the next couple of months because, the Boeing strike itself is going to affect the jobs report. But I think ultimately the Fed is still on a path towards getting back to neutral. I think that should be the focus, and that means, stocks which have been strong are really still a buy the dip market.
Let me know your thoughts about what Tom Lee just said down below in the comment section. The Fear and Greed Index today is out of extreme greed territory back into greed territory, coming in at 73, whereas 1 week ago, or on Thursday and Friday of last week, you were at about 75, which was extreme greed. As far as earnings today and after hours, you have SAP, that is a software name, that is the largest company that will be reporting earnings. So SAP could be important, but they are a European-based company, so I don't know how much of an importance the markets will take from it. Tomorrow morning, you have Verizon, GM, 3M, RTX, GE Aerospace, Lockheed Martin, Quest Diagnostics, Philip Morris, and Sherman-Williams. Tomorrow in after hours, you have Enphase, Seagate, Baker Hughes, Texas Instruments, CN, and some others. And then Wednesday, you have Vertiv, Boeing, AT&T, Coca-Cola, NextEra Energy, GE Veranova, Thermo Fisher, and Boston Scientific. Wednesday, you have Tesla, Lam Research, IBM, Newmont, ServiceNow, QuantumScape, Viking, T-Mobile, Las Vegas Sands. Thursday, you have American Airlines, UPS, Southwest, NASDAQ, Tractor Supply, Union Pacific, and others. And then Thursday, you have Dexcom, Deckers, Western Digital, Skechers, Boyd, Coursera, Texas, looks like Texas Roadhouse, Appfolio, and some others. And then Friday, you have New York Community Bank, Colgate, Piper Sandler, and some others. Tomorrow morning, we do get Richmond Fed Manufacturing Index, manufacturing shipments, and services revenues that will be coming out tomorrow morning at 10 o'clock in the morning. You will get the money supply report and some ECB Fed speakers, but that's about it. So I think the main focus, again, really for this entire week will be what happens to 10-year Treasury yields. If they go up another, let's call it 10 basis points or 5 basis points tomorrow, I think that is really going to start to impact equities. As far as how much will this impact equities, I think that is very much the variable here. Could it cost 3%, 5% downside? Of course, for the S&P, 3% would be down to 565 on the SPY, and 5% downside would roughly put you back to about 555. But then again, it's hard to forecast what kind of damage this will cause to equities. But let me just tell you, today confirms that 10-year Treasury yields are not rising for the right reasons. They're rising for the wrong reasons. And you might say, what is the right reasons? Well, the right reasons would be a better economy. We did not get good economic data today. We got very bad economic data today. And 10-year Treasury yields rose like it was the greatest economic data that we've gotten in the last 3 months. That signifies the problem. Thus, why I'm highlighting that for you here in this video. So let me know what you think about this information down below in the comment section. Hit the like button as well as subscribe to the channel if you have not done so already. You guys have a great rest of your day, and I will see you in the next one.